defined contribution plans. Now, in this program, we have a very ambitious schedule in the time that you've been so kind to share with us. We're going to be looking at differentiating between a defined contribution and a defined benefit plan, identifying the components of net assets that are available for benefits to the participants, naming the financial statement disclosures that are required, identifying the audit considerations, and categorizing the tax filings associated with defined contribution plans. This course is an overview of the differences between contribution and benefit plans, the components, the disclosures, the audit considerations, and the tax filing requirements. We're going to break this into 6 chapters. In Chapter 1, we're going to look at an introduction to defined contribution retirement plans. Chapter 2, we're going to look at the financial reporting of those plans. Chapter 3, we're going to look at the disclosures. Chapter 4, we're going to go through tax status. Chapter 5, as you can see, is a really big one. We're going to be looking at 17 different areas of what you should do. What are the issues? What are the examples of potential problems? And then what are the audit considerations that we'll look at? 17 different ones we're going to study in that category. And then finally, we'll look at unique plan situations. Like I said, it's very ambitious for our 2-credit program here. But if you're ready, let's begin. We're going to start with our introduction to a defined contribution plan. Now, a defined contribution, as opposed to a defined benefit, the contribution plan says we know what we'll contribute each year. This is typically, for most of us, your 401k, where you're going to put in $18,000, $20,000, $22,000 each year, and then whatever it grows to, well, that's your luck or disadvantage. Note, you get to choose what the investments will be based on the categories that are available: stocks, bonds, large cap, small cap, international, etc. You get to choose because you are assuming risks and rewards in that area. The employer just says, I'll take it out of your paycheck, I'll put it into the trust, and in addition, I may even make a matching contribution of a small amount, 2, 3, 4, 5%. Notice the contributions are made out of your paycheck pre-tax. And of course, the contributions are sheltered from taxation while in the plan. They're taxable when you withdraw the money at some future point in time. Employees have the responsibility to determine the amount that they want to contribute and where they should be invested during that period that they are in the trust. Now, the amount available for retirement depends on what you invested in, what you chose. If presumably you chose some great stocks that have gone up in value, you'll have a lot. If unfortunately you chose some bad stocks or you decided to be extra conservative, you may not have as much. Note, the rate the employer will contribute is discretionary. Some employers, nope, not a penny. Others, they'll contribute a matching contribution up to a particular percentage. Now, the maximum employee contribution is determined by the IRS, and we'll show you how typically it changes as an index each year. Right now, it's around $22,500 as we move in to the current period, but we'll show you how it changes each year. Account distributions are determined by contributions that you've made, putting it in, investment gains and losses, and offset by any administrative expenses that the pension plan has. You'll note also, the employee receives credit for 100% of their contribution. You don't have to wait in that particular case to vest. It was your money. You just decided to defer it by putting it into the pension plan in advance of receiving it. However, the employer contribution will have a vesting schedule. The employer is going to say, hey, here's the carrot. As long as you stay for 2, 3, 4, 5 years, then it fully vests. You'll notice the characteristics of a defined benefit plan. Those are where we define the benefit you will be entitled to when you retire. Now, in the old days, when your parents or grandparents were working, this was the most common type, where when you retired, you got, 2/3, 70%, 75% of your salary for the rest of your life. That was the essential one. That was where the employer got to choose the investments because they were on the hook to make sure there was enough money in the plan to cover your retirement. So as you were working, you knew when you hit a certain age, typically like 62 or 65, you had reached certain amount of years of having worked in that company, you fully vested and you would be entitled to that amount, X percentage of your salary for the rest of your life. That is the defined benefit. We define the benefit you're going to get, and the employer is then obligated to make sure that they have enough money. By the way, that's the one that requires all that really sophisticated accounting, where you have to determine the service charge based on actuarial calculations, the interest the plan should have earned. If it had been a perfect plan and earned exactly what we projected, then minus the return it did have, so obviously there may be a shortfall or a windfall. Then you're going to amortize any bump up in benefits. You're going to have holding gains and losses. And your original obligation when you set up the plan and gave people retrospective credit for what they had already served in the company without having ever accrued anything because you didn't have a pension plan. All of those have to be aggregated together. That's the hard one to account for. The contribution plan, easy. We just take it out like payroll taxes. We distribute it to the trust and we're done. You'll notice also, this is fixed. The employer is the one who bears the risk. Everything is calculated based on an actuary, and the benefit distributed are determined based on your age, the years of service, and what was your compensation. So we see that you have the defined contribution and the defined benefit plan. You can see contribution, the funding may be discretionary. You may decide right now, I need every penny to pay that home mortgage. Or you may say, hey, I'm doing really well. I'll put in the maximum amount. Notice, mandatory with the defined benefit plan that they have to be funding it right now. Notice also, benefits are based on, for a defined contribution, the amount you've accumulated. With the defined benefit, it's based on an actuarial calculation. And the contribution basis, well, for a defined contribution, a factor of current compensation, service, employer contributions, etc., all factor in. While for the benefit, it's an actuarial determination. Well, administration and operation of a defined contribution plan. The administration of it is regulated by the IRS and ERISA. Now, parties to the plan are going to be the plan sponsor. Usually that's the employer. The plan sponsor is responsible for carrying out the legal and plan documents, distributing proper notices to all of us, filing required government forms on an annual basis, and determining if you're eligible for benefits. The plan administrator, that does the day-to-day operations. The service provider, they're the plan trustee. The trustee has the exclusive authority or discretion to manage or administer the plan. The plan's assets are held in a trust, and the trust must have at least one trustee to handle all of the contributions, investments, and distributions. Another item is the investment manager. The plan trustee typically makes investment decisions. Maybe during a recession and a bear market, they're going to pull money and put it in more conservative stocks that are bound to maintain. During flourishing periods where we have great opportunities, they may put it in slightly more aggressive areas, assuming that you have helped them make that decision. Notice the plan custodian holds the investments. Now, it may be a bank, a brokerage company, or an insurance company. And then, of course, you have the plan participants. That's you and me. The audit committee, which oversees to make sure that everything's being done properly and that nobody is a bad actor. You have the investment committee, the human resource and benefits department. They'll be monitoring and saying, we have new employees. Here's their new salary. We have former employees who've left. And by the way, they want to withdraw and roll over their plan into maybe an IRA. You have your payroll department, which is making sure they're notified as to how much of each paycheck should be withdrawn from an employee and deposited into the trust account. You have your record keepers, and they keep the records on each individual. And finally, you have your outside administrator. They deal with enrollment services, payment of benefits, and annual tax compliance testing. Now, the administrator of your defined contribution plan inherently carries the burden of fiduciary status. Now, what is that? Well, their responsibility is to focus on the interest of you, the participant, the beneficiary. The plan needs to exist for the sole purpose of covering your needs and then covering the expenses associated with those investments. In 2021, the U.S. Department of Labor issued guidance related to this, tips for hiring a service provider. More importantly, cybersecurity with cyber attacks and ransomware, and online security tips. Now, a defined contribution, and we have many different types, and there's lots of schedules here to help us understand what they would and would not be. You'll notice a 401k plan, the employer-sponsored defined contribution, personal pension account, contribution limits. Now, in a 401k, you'll notice right here, you have the $22,500, the employee contribution limit. Now, there is a catch-up. That is, if you're at 50 years old or older, then you're allowed to put in up to $30,000 a year. The 403b, this is also tax sheltered, and it looks like it's exactly the same. The difference is 401ks are for individuals working in industry. 403bs are for people who work typically for a government agency, the school system, the municipal town, etc. Great example of that one for me is my sister, who was a school teacher, a grammar school teacher for her entire existence regarding her work career. And she participated in a 403b. You have your 457 plans. They're available for certain state and local governments as well. You'll notice the amounts are virtually the same. Well, the Secure Act. The Secure Act was passed in 2019, and it required some plans to make plan amendments in 2022. The plan changes included one, now providing for 2 lifetime income illustrations, like lifetime income illustrations, LIIs, at least annually. One illustration needed to demonstrate the account balance as of a single life annuity, and the other would be a 100% joint or survivor annuity. We also have the beginning age for minimum distributions was changed from 70 and a half to now 72. So once you hit 72, you've got to start to look at the total balance, determine your actuarial life, and you have to make minimum distributions, which means it's now taxable. It allows certain part-time employees to make 401k contributions. There's a modification to the timing of distributions after death. It used to be that you could do it over an additional lifetime. Now it's typically 10 years. There is allowing distributions for birth and adoption, and allowing for COVID-related distributions and loans that were necessary, maybe because you lost your job and yet you still had a mortgage, you still had the kids' college education to pay for, etc. Well, with that, we're now going to move on and take a look at Section 2, Financial Reporting of a Defined Contribution Retirement Plan. Let's take a look at some of the items. Now, there's 2 major statements. We don't call them this, but you can think of them as the balance sheet and the income statement. Now, the balance sheet actually is known by the name, the Statement of Net Assets Available for Benefits. And it has assets and liabilities, net assets, which reflects all investments at fair value, and net assets available for benefits. You'll notice the key components of your net assets available for benefits would include, and we're going to take a look at each of these: cash, investments, participant loans, contributions, rollover contributions from possibly another account, other receivables, forfeitures, an individual who put money in and had the matching contribution by their employer, but they've left, so they forfeited the matching contribution. They weren't there long enough. Property, plant, and equipment, and accrued liabilities. Now, participant allocations, net assets available are allocated to individual participants in a defined contribution plan according to the documents. They're all presented at fair value, which makes a lot of sense. If a company, and you specifically, if you had invested in the XYZ stock, and you did that 20 years ago when it was worth $20 a share, and today, 20 years later, it's now worth $300 a share, wouldn't you want to know how much I have available when I retire to live on? Not how much I invested in. And by the way, one of the things that people get a little bit confused by, and I would like to point this out, and I've seen this on several occasions in my practice, where somebody inherited, say, a parent's pension plan, and they say, well, they bought all these stocks of the company 20 years ago, and then when they left, they rolled it over into an IRA, but the stock has grown and grown and grown and grown. So I'm going to get capital gains, right? Wrong. It's all ordinary income. Ouch. So be aware of that. When you withdraw the money, you don't sit there and say, well, how much has it gone up in value since I originally acquired it in the plan? That doesn't matter. It's all 100% going to be taxable as ordinary income. Remember, you didn't claim it as income when you earned the money. It was taken out of your paycheck and put into the contribution plan. So it still has to be taxed, and it will be taxed as ordinary income. Now, defined contribution plans permit periodic contributions. They even allow for withdrawals under certain circumstances. You'll notice plan assets need to be valued properly at the time of a participant's directed transactions in order to properly state the plan assets. So let's take a look at the first of these 9 items, and that is the cash balance. You'll notice it's a non-interest bearing account. You don't want any risk. You're concerned. The market is a bear market at this point in time. You don't want to be making an investment and literally possibly having it go down in value. So you say, just hold it in cash. It's deferred. I don't have to pay taxes on it, but let it just sit there. All right. Often this is just a clearing account until you have decided where you're going to invest your money. Now, interest-bearing accounts, it relates to investments. Now, you may have chosen to say, I want to be in the bond market, or I want a very secure treasury note. I don't want to play with the market. I'm too old, and I wouldn't be able to have enough time to recover if there is a bad situation. Investments, normally most of us will allocate at least some. Others will allocate almost all of the money in their contribution plan to such things as stocks and bonds. You'll notice some assets may need alternative measurements, like if the plan allows for investments in real estate, if the plan allows for limited partnerships, then under those cases, then you have to use an alternative. I mean, how are you going to determine fair value each period? Well, you may be looking at methods of holding investments like collective trust, registered investment companies, or pooled separate accounts. You'll also notice you may be investing in master trust. Now, common investment types are participant directed accounts. That's where you choose the different investment options. An example, you may every so often, typically in the October, November area, your firm, your company will notify you that it's time to select your investments. Do you want to still participate in a defined contribution? How much do you want to contribute? And then what types of investments would you like to have it put into? There may be a non-participant directed account. This is where the trustee directs it. That would be for your pooled investment accounts. Obviously, you can't direct where everybody else has to invest. Self-directed accounts, where the participant may invest their account in any investment approved by the plan and allowed by ERISA. And then separately managed accounts. The accounts contain individual plan assets and are held by a trust company and managed by an investment manager. Well, the third type of asset is the participant loans. One of the things you're allowed to do is borrow money from your 401k. Typically, this is when there's a dire need. You may need to borrow the money now. The thing that a lot of people like is, hey, I'm borrowing the money. I'm going to pay interest on it, and that interest may be deductible as an itemized deduction. And I say maybe. You'd have to determine what the purpose of that loan was. But let's assume it was. And in addition, then the interest that goes into the trust, well, that's again going to be part of the earnings, which gets deferred until you withdraw it. Notice, the documents must allow these loans. The loan is secured by your balance. That's typically why they'll say maximum 50% you can borrow, so that there's tons of collateral. If you ever default, well, guess what? They've got your collateral. And of course, loans are presented at their unpaid principal and the accrued interest that you haven't paid yet. Now, maintaining participant loans, that's the responsibility of the record keeper. Now, responsibilities of the record keeper would include calculating the amount of available for loan, determining the eligibility based on the documents, and maintaining a loan amortization schedule. So every payment is partially principal and partially interest. Now, they also recording the loan information. The loan is deducted from your investment account as shown as a note receivable. The funds are transferred to the participant by the trustee, so you actually get the money. Now you can use it for emergency medical. Maybe you wanted to do something else, etc., whatever. And loans are frequently paid back through payroll deductions. It's probably the most painless way to do it. You needed this lump sum of money, which you had, obviously up to a percentage of the outstanding amount you have in the account. You're going to use that for whatever that need is. And then over the next X periods, the payroll department will take a piece out to repay both interest and principal each period. Now, loan and distributable events. Notice right here, a loan to a participant who incurs a distribution event is considered a distribution. And distribution events include employee termination, where you can pull the money out. And let's say you're not old enough to want to retire. You're moving on to another company. You can roll it over into their 401k. You can roll it over into an IRA, or it may be death of the employee or disability. Distribution is recorded for such a loan, and it is removed from the statement of assets available for benefits. Now, delinquent loans, of course, unfortunately, it is going to happen. Somebody took the money and then COVID hit and then they lost their job, so it couldn't be taken out of payroll, and they don't have funds to pay it back. In fact, they're really financially strapped. Now, for each active participant, a delinquent loan remains outstanding until a distributable event occurs. Now, the types of contribution. We're going to look at both employer and employee contributions right here. And we're going to highlight, first of all, employer. There are the discretionary ones. They may ultimately agree to give a match. That match may be 1, 2, 3, 4, 5%. Now, there may be mandatory. The employee benefits, such as a specified match of the employee contribution based on a contractual agreement, more likely than not through a labor agreement, a labor union agreement. There is also the types of contribution can be cash, where they put cash in, or they can put in non-cash, typically the employer's securities. They say, well, we'll match, and by the way, our stock is worth $100 a share, so we'll give X amount of shares on your behalf. Now, for employees, it's the pre-tax contribution that you're going to be making, typically right out of your payroll check. There may be after-tax. Defined contribution plans can include a Roth option that is made after income taxes. Remember, the Roth option says you don't get any deduction for it now. You pay taxes on your earnings, you put it into the Roth, but it accumulates tax-free, and the withdrawals are also non-taxable. That's a really good option, and a lot of people like that for their selection if it's available with your documentation. And of course, then there's rollovers. Maybe you worked for another company, you had a pension defined contribution plan there, you've left, your employer allows rollovers of the contributions from that other company's plan into yours. Now, contributions receivable. For contributions receivable, evidence is needed of a formal commitment to the employer's contribution, such as a resolution by the board, established company policy, or deductions of contributions on the employer's federal tax return, a contribution payable on the employer's financial statements. Those kind of document the intent and the requirement. Now, factors in substantiating it. Well, contributions is related to a participant's wages or their service. Notice in this case, contribution is based on criteria such as company performance, like we hit a certain mark of revenues, we hit a certain mark of sales, our stock hit a certain price, or you've worked for so many years. Plan terms or formal resolutions require that contribution. Plan management intends to make it if it's discretionary, or there is a reasonable timing after the end of the year to make the contribution. And you say there is, and yes, there is. Determining contributions after year end is based on the facts that existed before year end, like what is net income or what is your base salary. An employer may be required to contribute to a qualified non-elective contribution because of a failure of a 401k test. You may not have met one of the tests where it's anti-discriminating or it's top heavy, which we're going to learn as we get into one of these other chapters, chapter 4 specifically. We'll talk about that. And because of that, you had to make extra contributions in order to resolve the failed test. And discretionary contributions may not be known until your financials are formalized. Now, rollover contributions, the definition is a transfer of balances from one qualified plan or individual account to another one that the company allows. This can happen because of an acquisition of another company, where your company was acquired by a larger company and they just took all the 401k contributions and rolled them over into their plan. Now, transfers that result from plan mergers or spinoffs initiated by plan sponsors are not considered rollovers. Now, the sixth category is other receivables. This could be investment related, like interest and dividend income that hasn't been transferred yet, right? A dividend was declared on the stocks that are held, but it hasn't been transferred and paid yet. Securities and lending, amounts due for securities that were sold. Your agent sold the security but hasn't transferred the money to you. They did it on the very last day of the month or the end of the quarter or the end of the year, and they'll send it to you in 24 to 48 hours. You'll notice also activity related to any derivatives. Now, fee reimbursements are also going to be an item there, as well as a refund of a distribution in excess of a participant's interest in the plan. Oops, we gave them too much. And then we have the seventh, forfeitures. As I mentioned a little bit earlier, the employer's contribution typically will have a vesting. They want to hold that carrot out in front of you. So they may be saying, all right, we're going to put in an extra 5%, but you have to stay here for at least 3 years for it to be vested. And you left at the end of 1 year. You went on to a better job opportunity. Well, then that amount that they did put in now is forfeited. And then we have to decide what happens to that forfeiture. Now, the plan documents will specify how it should be used. Well, it will reduce future contributions. Will it pay for administrative expenses? Will we reinstate a previously forfeited account of a rehired, previously terminated participant? Will we allocate it to the remaining participants so they have a little bit of extra money? The eighth category is going to be operating assets. Your property, plant, and equipment right here. Buildings, equipment, furniture, and fixtures. And reporting for the statement purposes is going to be cost less accumulated depreciation. Notice all of this will be reported on your Form 5500. And by the way, all the other items reporting plan assets are at, as we said earlier, fair value. You'll notice accrued liabilities. We have liabilities other than for the benefits themselves, the amount we owe the people. This can be for accrued expenses like administrative expenses that will be charged at the beginning of next quarter, management fees, or maybe your accounting CPA fees. You'll notice it could be amounts owed for securities that were purchased. So the investment advisor bought securities, but now they bought them in the company's name. They're going to transfer them to the trust, but the trust has to pay them. Obligations to return securities, derivatives related payables, refunds of excess contributions, interest accrued, that could be on an ESOP debt, income taxes payable by the plan, maybe on unrelated business income, which we'll talk about a little bit later, and amounts due to the plan sponsors. Well, now that was the balance sheet. What about the income statement? When it comes to the income statement, we're looking at the change, right? The statement of change in net assets available for benefits. So how did it hopefully grow, not shrink and contract? So the change in fair value, it would show investment gains or losses do not need to be segregated from unrealized gains and losses. Details may be presented in the notes. Investment income exclusive of changes in fair value, where you may have had interest income, dividend income coming in, dividends and capital gain distributions, and of course that are reinvested into the plan are to be shown as investment income and not part of changes in fair value. So if there was a growth and a dividend or capital gain distribution was paid, but you elected, no, I don't want the money, just reinvest it in the same company's stock, then that is shown as investment income, not as a change in the fair value, because you earned it and then went and bought more. Contributions, the employer's contribution, we're segregated between cash and non-cash, usually cash and then their stock. Contribution should be shown net of forfeitures. Contributions by participants would be the second category, right? You had employer contributions, which are small. Employee contributions are going to be the larger one. Rollover contributions by employees who move from one company to the next. Participant benefits, distributions, and withdrawals. The amount, the timing, and form are determined by the plan. And benefit payments, those are recorded when paid. And the plan provisions should determine how, when, and in what form they should be paid. You'll notice also plan expenses, right? You're going to have to pay them, and they're typically paid by the sponsor. Some plan expenses are paid directly out of the assets. So therefore, that is where you see the expense. Otherwise, you see it as a sponsor expense. They pay them, and then they get reimbursed. You'll notice expenses paid out of the plan assets must conform to the Department of Labor regulations. And that would include the most important item, a settler function. Those are not allowed to be paid out of the plan functions. You'll notice a plan formation, design, and termination decisions are among those items that are settler functions. You'll now notice some administrative expenses may be difficult to understand, like they may have been netted against income. They may not be clear on the statement of the service provider, or some plans may offset plan expenses against investment income. Therefore, you may want to put more information in the notes to clearly explain how certain accounts were derived and that they're consistently applied that way. Now, the type of plan expenses, there's a lot of them. We have investment management and advice, trustee expenses, custodial expenses, record keeping, professional fees, loan processing fees, reimbursement of plan sponsor costs, as we just mentioned, and other transaction or processing fees. So you get an idea of all of those types of items that are very common, incurred and reported. Well, with that, we're going to jump into chapter 3. Now, in chapter 3, we're going to take a look at disclosures. Now, in this particular area, I'd like to start out with key requirements. Notice, disclosures should include description of the value methods used to determine fair value, also less cost to sell if significant, methods and assumptions used to report values of insurance contracts, and the following is applicable: basis of accounting if other than GAAP, use of estimates, notes receivable from participants, payment of benefits, risks in this particular case of uncertainties, a brief general description of the plan agreement. For example, how do they vest on the employer's contribution, allocation provisions, disposition of forfeitures? Does everybody get to share in them? Are they reimbursed to the company? What's happening there? Significant plan amendments, the amount of unallocated assets and basis of allocation, the basis for determining contributions by employers, if applicable, whether ERISA minimum funding requirements were met, the amount of plan administrative costs paid by the employer, federal income tax status, related party transactions. All of those are fundamental disclosures that you should be considering. Now, when we talk about the fair value measures, responsibility is the plan management is responsible. And resources they can use are investment managers to get that information, trustees, custodians, and even outside service providers. Regarding the framework, disclosure about it, it's required to coordinate between the manager, the custodian, and the plan auditors. There's a whole appropriate valuation process, and you should have sufficient data to present in the disclosures about how you arrived. Is it consistent with the past, what your assumptions were? Was it level 1? Was it level 2? Was it level 3? Of course, techniques can be the old-fashioned ones you learned way back in Finance 101 in college. You can use the market approach, which is an observable, typically level 1, but might be a level 2, the cost approach, or the income approach, which is typically your discounted cash flows. Well, changes in valuation techniques. The valuation techniques should be used consistently, unless some major event occurred that would not allow that old-fashioned method that you've been using to be indicative of what the value is. So some of the following occurrences may mandate or may precipitate that you should change your methodology. There's a new market development, new information. Information previously used is no longer available. Valuation techniques have improved, or market conditions have changed significantly. You'll notice also investments that calculate net asset value. Some investments provide for a net asset value per share, like hedge funds, private equity funds, and real estate funds. Now, if a readily determinable fair value is not available, the reporting entity can estimate the fair value using a net asset value. Net asset values may not be used if, at the measurement date, it is probable that a plan will sell the investment for an amount different from that net asset value. You don't want to mislead people and say, well, we don't really have a fair value in the marketplace per se, so we're going to use net asset value, where we're going to take the best we can for determining assets minus liabilities to come up with net asset value. Oh, by the way, we're going to sell it for a much different price. Wrong. If you have an intent to sell it, if you've been negotiating and the price range can be determined, that would be a better approach. Oh boy, derivatives and hedging. I know a lot of people look at this and say, please don't go into this really deep. I don't like it. And I get it. It's a very complicated area. It's very specialized, typically in Treasury, but we have to be aware of how to report it. A derivative is an investment that derives its value from an underlying item. In other words, you may have a contract that says you can pay us back either in the US dollar or in the euro on December 31st. And let's presume each of them was worth $1 equals €1 €1 equals $1. I know that's not the case right now, but let's pretend it was. So you can say you can pay us in either one. Well, that value, that receivable is going to be valued based on which one is the least expensive for that customer to pay you in. It may be based on interest rates. It may be based on fair values. So a hedge is literally trying to offset risk by surrendering the potential upside to a counterparty, Deutsche Bank, Bank of America, Goldman Sachs, etc. And this can be based on hedging of interest rates, commodity prices, foreign exchange rates. Now, the types of common derivatives are commodity futures and financial futures, options, forward contracts, foreign exchange contracts, and of course, your swaps. Now, disclosure of each of those items, how and why you're using it. What's the purpose of trying to mitigate a risk? How they're accounted for, typically since they are financial instruments, and if you qualify for the privilege of hedge accounting, then you would do fair value accounting. You do mark to market. Now, where that adjustment goes depends on what kind of a hedge it is. Will it go to the income statement or does it go to OCI? Would be an issue there. How they affect your financial position and performance, as well as cash flows, the objective of doing this, the context needed to understand what the objectives are, your strategies in this area, and any other additional information which would allow the user to have a fundamental understanding of how you're managing the organization's risk. Now, master trust presentation and disclosures. You'll notice here, the master trust is the trust held by a regulated financial institution, such as a bank or a trust company. You'll notice right here, they hold assets of more than one plan sponsor by a single employer. So you may have the labor unions plan, you may have the white collar workers plan, and you may have the high level executives plan. And by the way, you may have different plans that were in effect when one leadership team was in effect in the 90s, and another one when you had a brand new leadership team come in 2015. So it's possible. And of course, it could be holding assets of more than one plan sponsored by a group of employers under common control. Now, for each master plan in which you hold these interests, the plan must present that interest and the changes in that interest on a separate line. A plan must disclose in the notes to the financials for each period, one, the net appreciation or depreciation in fair value, investment income, a description of the basis used to allocate the net assets, and for a plan with an undivided interest, its percentage interest. And you say, what's an undivided interest? Well, an undivided interest refers to a scenario in which the plan has a proportionate interest rather than a specific interest in the master trust. Now, a plan must include in the financials notes regarding the investment of the master trust measured by using fair value. Now, investment types include registered investment companies, government securities, common collective trusts, pooled separate accounts, short-term securities, corporate bonds, common stock, mortgages, real estate, and even self-directed brokerage accounts. You'll notice a plan should disclose the master trust other assets and liabilities. Some examples would be the amount due from brokers for securities sold, amount due to brokers for securities bought, receivables related to derivatives, payables related to derivatives. The receivable would be if the derivative protected you. The payable is if, unfortunately, you bet the wrong way and now the derivative, all that profit that you would have otherwise had, you have to give to the counterparty, the accrued interest and dividends, and accrued expenses. So here's an example. You'll notice we have the master trust, and then you have the plan's interest in the trust. So you have the master trust, and you can see they had $13,560,000 in funds, of which we have $6,816,000. And then you have how much common stock, how much government securities. In that case, we didn't hold any of those. Corporate bonds, total. Plus due from brokers for securities sold, less accrued expenses, maybe for professional fees, etc. So therefore, there's our portion of the investment. That's a great way to illustrate exactly what it would look like. Nothing really that complicated. It's almost like, a division or a segment of the master trust. Well, let's take a look at financial instruments. Disclosing the fair value is required to be in the statement or the notes, and you must in the notes include assumptions that were used to determine that fair value. Now, disclosure guidance for fair value is optional for plans if all of the following occur, if you meet each one of these. The plan is a non-public entity. the plan's total assets are less than 100 million on the date of the financials, and the plan contains no derivative instruments. In that case, then you'll notice the disclosure guidance is optional. Now, disclosure of significant concentrations of credit risk would include information about identifying characteristics of that concentration. We're heavily involved in tech stocks. We're heavily involved in pharmaceuticals, etc. The maximum loss due to credit risk, policy of collateral required to support financial instruments, and the entity's policy to reduce that credit risk. Maybe you have sat there and you've hedged it. Now, in addition, we're going to take a look at risks and uncertainties. And when it comes to risks and uncertainties, we want to examine the nature of the plan's operations, the use of estimates, the vulnerabilities due to uncertainties and concentrations. That occurs when the plan is exposed to risk of loss greater than if it would have been if it had mitigated the risk by diversification. And concentration may be in a single industry or maybe in one geographic area. So you get the idea of how this all plays out. As far as more information is always useful to help the investor understand how this is being accomplished. Well, that's now going to lead us to Chapter 4. And in Chapter 4, we're now going to take a look at plan tax status. We're going to take a look at required annual information, non-discriminatory and compliance testing. In the old days, and I'm going way back, there used to be a way of basically, taking money out of the pockets of the hardworking rank and file and only putting it in the top executives. And the way we used to do it was basically a discrimination process. It was your integration. What you used to say is, our pension plan is your Social Security. So hypothetically, if Social Security had to be paid up to, say, $150,000, well, then up to $150,000, we don't offer a pension plan if that's your salary. You got Social Security and you don't need anything else. Well, that included most of the rank and file. They didn't make over that. Oh, the top executives that were making $1 million, $1.5 million. Oh, we take care of them by having a pension plan, but it only becomes effective for an amount over that Social Security amount. Well, you can understand that just doesn't sound right. It doesn't sound fair. So the IRS says, listen, you can do that, but then you're not getting tax advantage situations, etc. If you want to take advantage of the tax code, then you have to comply with certain non-discrimination. And by the way, we're talking about taking care of the rank and file versus the executives or the owners. And of course, you have to comply with certain tests. So the tests for the Internal Revenue Code sections would be a 410B minimum coverage test, the 401A4 non-discrimination test, again, rank and file and execs, the 401K and 401M average deferral and contribution percentage limits, then the 416, the top heavy test, and then 415, the benefits and contributions limits. When you start to think about when you see percentage limits or other test limits, those are usually referring to how much can you put in. Like we just said in some of the tables there that you saw, plus possibly having the catch-up if you're 50 years of age or older. You'll notice there's also a 402G employee deferral contribution limits. That's applicable to how much you can put away into your 401k. And then your 412 and 430 minimum funding obligations, right, with your applicable for money purchase pension plans. Non-discrimination. Per the Internal Revenue Code, plans cannot discriminate in favor of the highly compensated execs. In other words, the owners and the top dogs. We have to be equal to everybody in the plan. So a highly compensated employee is one who owned more than 5% interest in the business at any time during the year or the preceding year, or received compensation from the business of more than $125,000 if it was before 2019, $130,000 in 2020, 2021, $135,000 if it was in the preceding year was 2022. And notice also, if an employer so chooses was in the top 20% of employees by compensation level. You can see we have a table here with the Internal Revenue Code section and the type of test. Whether it's a coverage test, are you taking care of everyone? A rate test, how much are you putting away? An average deferral limit, what the cap is and you can't give away or put away any more than that. The benefits and contribution limits and the employee deferral limits. Now, failure of a discrimination test. Unfortunately, this year it was all the top executives. What happens when maybe the rank and file choose not to put money in? That can create a problem. So often, in this case, when you propose this, the plan administrator must take corrective actions for the failed test, as we said a little bit earlier. So there may be an additional contribution that goes in very, very quickly. Now, corrective actions can be additional contributions, refunding excess contributions to a high-level executive and say, we got to give it back to you. We're not allowed to take that amount into account. Corrective measures that are stated in the plan documentation. So what additionally is the effect of that failed test? If the plan administrator does not take the required corrective action, the auditor should consider the implications on the financials. This failure could endanger the plan's tax advantage status. Now, the IRS has relief programs that are available in this case. So there are extensions for corrective periods, expansion of corrections by plan amendments, extensions of a sunset or safe harbor correction for employee elective deferral failures, and the expansion in flexibility for recouping overpayments. Now, unrelated business income. You'll notice right here that benefit plans generally are not subject to tax, right? First of all, when the money is going in, it was taken out of your paycheck pre-tax. So when you get your W-2, you may see that you earned $300,000, but you're only going to be taxed on $280,000. What happened to the other 20? That was the money that you elected to put in to the defined contribution plan. Not taxable now, taxable when you withdraw it at some subsequent point in time. You'll notice here, certain activities or types of investments, though may generate it, notice here, unrelated business taxable income, your UBTI, right, which is gross income derived from an unrelated trade or business minus the allowable deductions directly associated with that unrelated trade or business. Now, an unrelated trade or business means any trade or business that is regularly carried on and which the trust invests. So in this particular case, maybe the pension plan decided to open a snack bar or something like that, or to open up a rental facility with some buildings. Now, a qualified plan can incur unrelated business income tax when a business activity of the investment passes through to the investors. So examples would be investments in partnerships that are pass-throughs, right? Partnerships are pass-throughs. And in this case, that generate income from activities such as rents from debt finance properties, rents based on percentage of net income rather than gross income, rents on personal property, or unrelated debt financing income. That would be your UBI, unrelated business income. Well, income taxes. A plan position as a tax exempt is subject to some uncertainty if you don't meet the test. So uncertainty with respect to unrelated business income tax is another major area. Judgment about whether the activity is a trade or business, whether it's carried on regularly, and uncertainty in computing it are all issues that have to be addressed. Now, uncertainty regarding the plan's tax exempt status can judge in from that area as well. Well, audit considerations in this category. When it comes to the audit considerations, relevant assertions have to be considered. Per the Internal Revenue Code, the trust qualifies as exempt from federal income taxes, and any income taxes have been properly recorded and disclosed. That is one of the assertions that the auditor is going to be reviewing from management's perspective. You have to have identified risk examples. The plan document is not timely implemented or amended. The plan operations are not current with changes in tax law. One of the scary things, and I can tell you in our practice, we decided not to get involved in administering pension plans because they change so quickly. And if there's a forfeiture because of the fact that you are no longer a qualified, it can have significant tax consequences. And we just weren't set up to constantly be monitoring that. There are financial planners that are involved in this, et cetera. Much, much better. If you don't have people internally who are committed to keeping up with this on a regular basis, it may be better to partner with an outside agency that handles this. They do all the calculations. They make sure the plan amendments are done in a timely manner. Now, plan provisions have not been applied appropriately. The non-discrimination tests have not been performed, or corrections have not been made to address compliance failures. Well, audit procedures that you may want to consider. Review IRS determination letters and IRS opinion letters. Determine whether your plan amendments are up to date. Ask the plan administrator if the plan operations have been changed to meet the current tax laws as they currently apply. Also, you want to ask about the procedures with regard to determining unrelated business income. Ask the plan administrator about operations and changes that may result in losses of your tax exempt status, and ask plan management whether required compliance testing has been conducted and what were the results. Now, obligations to provide a 1099-R when distribution is made. Right? This is something that we, the accountants doing tax returns, absolutely require from our clients. How much did you get distributed to you this year in your retirement? Right? So this is the amount paid to the beneficiary, the employee or former employee. They are required to be mailed out by January 31st. Think of your W-2s at the same time. What's provided as information on this? Well, it's the participant's information, name, address, social security number, the amount distributed, dollar amount, the taxable amount. Now, there may have been, in some crazy circumstance, an amount that was a return of capital, possibly, and then the amount that's taxable. Typically, they're either the same or very close. Any federal taxes that were withheld on that, which is usually one of the requirements, and any special tax rules that would apply. You'll notice distribution codes that are include the following. So this would actually be on the back. Usually in one of the boxes on the 1099-R, you'll see numbers and you'll see a small little bracket with the code 1, 3, 4, 7, or G or L. And you're like, what do those mean? On the back of the 1099-R, it will tell you. Code 1 is used for a distribution to an individual who is age 59 or older with no known early distribution excise tax exemptions. Remember, you have to be at least 59 and a half for most distributions. There are some exceptions. If you're younger and you took it out and none of the exceptions applied, there's also a 10% penalty tax. Code 3 is for a payment because of disability, which means you're obviously going to waive the penalty no matter what age you are. Death is code 4. 7 is normal distributions. That's the one you usually see. 7, as I said, is normal. G is used for direct rollovers to a qualified plan. So typically, you'll look at the 1099-R, and a person says, well, I left company A and I just moved to company B. I removed my pension plan, my 401k from company A, and company B accepted the rollover. Well, company A is going to say, well, we did give them the money, but it went directly to company B's plan. So that's a code G. And code L is used for loans treated as deemed distributions. Well, filing the 1099-R form with the IRS, the plan administrator, plan sponsor, or custodian may file it. For paper forms, it's due to the IRS by February 28th. If you're doing it electronically, you get a whole extra month. And by the way, why wouldn't you do it electronically and then get the confirmation? Now, every so often, there's a problem with electronic filing. I get it. I always say file early. Why? Because if your office has experienced things like my office, you electronically file something, everything looks good, and then a day later you say, nope, it was rejected because some box wasn't checked or whatever. Uh-oh. Now, technically, is it late? So you want to do it early so you can make any corrective actions you can in advance. Don't wait till the last day. Explanation to recipients before eligible rollover distributions. The plan administrator must provide each recipient with an explanation called a 402F notice. It must be provided no more than 180 days and no fewer than 30 days before making an eligible rollover distribution. Now, the Form 5500, that's the annual tax return. It's for plans with 100 or more participants, and you're required to have an audit of your financial statements. Filing due date, the filing date is the end of the 7th month following the close of your year. Now, you can ask for an extension by filing a 5558. That would give you an extra 2.5 months in order to get this thing filed. Now, an exception to large plan filings of audit requirements. There's the 80-120 rule. Now, if the number of participants at the beginning of the plan year is between 80 and 120, and a Form 5500 was filed in the prior year, the administrator may elect to file the same category as the prior year, either large or small plan. And if you filed a small plan, an audit was not required. You'll notice the 5500's required schedules. This is for your defined contribution plans. Schedule A, which is used to report insurance information. Schedule R, to report required contribution information. Schedule F is to report financial information on large plans. Schedule C is to report service provider information on large plans. Schedule D is used for large plans to report certain types of investments. Schedule I is used for small plans to report financial information. You'll note also, what about these small plans? You'll notice a Form 5500 SF may be used for small plans. It is a shorter form with no required schedules for defined contribution plans. Now, the requirements for it are the plan covered fewer than 100 participants. And remember, you do have that one exception, the 80-120 rule that we just talked about, where you may still be able to use it. The plan did not hold any employer securities. The plan had 100% of its assets in easy to value assets. The plan is eligible for waiver of the annual examination and reporting by an independent accountant, right? The small plans don't need that audit, and the plan is not a multi-employer plan. Those are some of the fundamentals that are involved in this category. So you get an idea of some of the tax planning issues and plan status that is associated with these types of plans. So let's move on right now and take a look at our next category. Audit considerations. This is a big category. We've got a lot of material to cover, about 65 slides. And as I mentioned earlier, this is where we're going to have 17 different accounts and what the concerns are, what the issues are, examples of them, and then how you should approach and attack it. So we're going to take a little bit of time to cover this area as we go through the material. So audit objectives and your engagement. Well, SAS, Statement on Auditing Standards 136, forming an opinion and reporting on financials of employee benefit plans subject to ERISA. It includes the following. It clarifies the responsibility of the auditor, which is obviously to express an opinion on the fair presentation, and management's responsibility for handling the record keeping and providing those financials. Management must affirm that the ERISA election, formerly limited scope audit, is permissible. A substantially completed Form 5500 must be provided to the auditor by management prior to the issuance of the audit report. Remember, you're not auditing the tax return, but you want a copy of it because that's going to the government, and you want to verify that what's going to the government in the tax return and what's in the financial statement are literally going to be reconciled and agreed. The auditor must communicate any reportable findings where there was non-compliance, any potential fraud that was going on, any area that they disagree with how it was reported, or any other type of relevant information. Well, let's talk about determining your audit strategy. When it comes to determining your audit strategy, the auditor needs to have an understanding of the activities performed by different parties. Now, activities performed. We have one group investing and holding the plan assets, others processing of contributions. We have another group, notes receivable from participants and managing those and calculating the amortization table, benefit payments and the related expenses that are going out to sponsors or administration, the execution of transactions when there's a determination we want to switch investments or it's necessary to switch investments, who's maintaining the records. So the auditor needs to understand the key elements of the plan documents. Who's eligible? Is it all people who work at least 20 hours? How about if somebody works on a subcontracting basis but is paid through a W-2? What are the contributions to be made? How is vesting for the employer matching contribution done? The participant allocation factors, distribution to benefits, and other distributions and plan expenses need to be understood. That's why you read over the documentation. Now, the auditor needs to have an understanding of the controls and risks surrounding the activities determining substantive testing. That's your dollar balance testing. Some activities are performed by the plan sponsor, like controls may be in place that can test at the plan sponsor. This reduces the substantive testing you have to do. Now, often controls at the plan sponsor are minimal, and substantive testing would be required. But sometimes there's more rigorous controls are in place at the plan sponsor, and in that case, well, then you're going to have better opportunity to reduce some of the substantive testing. Now, what we're going to be doing in just a moment is we're going to be breaking each of the 17 accounts that I'm going to be mentioning to you into what are the assertions that management would be making that you want to verify, what are the risks that there could be that those assertions are not accurate, and then what are the audit procedures we should apply to those assertions and risks to confirm that we're comfortable in rendering our opinion. So we're going to break it. Assertions, that I'm going to call letter A. Risks is letter B. Procedures will be letter C when we go into the 17 different categories. So here, the determination of your audit strategy. Some activities are performed by a service organization, such as being the trustee, being the custodian, or maybe you do have outside administrators. Now, a type 2 SOC report is sometimes available for those service organizations. Now, a service organization, think of a payroll company and a pension plan company. They don't want every single client who has their money with them to send in their auditors and audit that service organization. So they may have their own independent audit done where there's a report that says their controls are in place and that they're doing a fine job. So now the company that uses this service provider, that company that uses them, that auditor can rely on that audit report from the service provider. So sometimes it's available for those service organizations that include controls and testing in that organization. This can reduce the need for substantive testing in that area. Now, the audit strategy, when controls are not in place or tested at the plan sponsor, would include, obviously, more substantive testing, more dollar balance testing and double checking. So what are these 17 different categories we're going to look at? We're going to look at, first, participants' accounts and allocations, cash, investment and related income, notes receivable from participants, contributions, contribution receivables and data, rollover contributions, other receivables, forfeitures, other accounts, accrued liabilities, notes payable from an ESOP, participant benefit distributions, and in this case, withdrawals, plan expenses, considerations for ESOPs, plan mergers and spinoffs, terminating plans, and changing service providers. So we've got 17 areas that we will look at, and we'll look at A, B, and C in these categories. A is, what are the relevant assertions for participant accounts and allocations? Well, it's the accuracy of the net asset allocation to the individual participant, right? I may be very aggressive in wanting lots of big giant tech stocks. You may be very conservative and want it all in bonds. Well, obviously, the returns on each of those have to be calculated and properly allocated. The valuation and completeness of participant accounts and the authorization and accuracy of transactions within each individual account. That's the assertions. Examples of identified risk would be participants' deferral amounts or investment options may not agree with their elections. Hey, I wanted it to be in high-tech stocks. Why am I in international companies, or why am I in bonds? I didn't ask for that. We have income or expense allocation of income may not be accurate, right? In other words, my huge gains wound up going to the person with the bonds. Their modest income wound up being allocated some to me. That's not fair. Absent or incorrect reconciliations by management may result in missing contributions or incorrect allocations. And then we have, what are the audit procedures you'd want to consider to mitigate that? Well, test the allocation of income, administrative expenses, and forfeitures. Test controls of record keepers, especially by using the SOC 1 report. Test allocation of plan investment earnings. Test the allocation of the employer's contribution. Determine that participant contributions are credited to the proper participant. If I had payroll money taken out to be put into my account, but it was given to Joe Blow or Mary Smith, right? That's not correct. Compare the initiated trades to detailed record keeping. Determine that the sum of the individual participant accounts reconciles with the total, right? All of the individuals should add up to the grand total. And ask plan management about complaint processes and reviewing of complaints, right? Somebody could say, hey, I'm not getting the right amount. I didn't authorize that. Or why did you do that with my account? Where's the authorization for that? Should those be noted? What's the investigation? How are they resolved, right? This is all about trying to achieve best practices, listing red flags in this area. Very, very important. The second of the 17 is cash. Now, when it comes to cash, we're looking at relevant assertions here. Note, all cash balances are recorded and exist. The plan owns the cash balances, right? We want to make sure it's in the trust's name, the trust has control over it, the trust has discretion on it, and the financial statements correctly present and disclose whatever the cash balance is. Well, that's the relevant assertions regarding just simply cash. What are some of the identified risks? Well, some cash accounts, such as suspense accounts, may be omitted from the financials because they are not included in the trust statement. A significant amount of cash may be held outside the plan due to uncashed checks not properly accounted for in the financials. And then we have, what are the audit procedures that you have to consider here? Well, substantive audit procedures typically used in an audit of other entities would be appropriate for material cash balances. getting a confirmation, finding out if there's any loans against it. What are the amounts that are also in transit? Doing a bank cutoff statement, right? All of those would be important. And ask the plan management about any omitted balances possibly held by the sponsor, the trustee, or the custodian. Well, let's move on to our third area, which is investment and related income. Now here, the relevant assertions are, do these investments exist? Have we got a complete list of them? Do we own the rights to them? Are there any obligations associated with them? Have we properly valued them at fair value? And have we allocated appropriately? And are they properly presented and disclosed? So what are some of the identified risks in this category? Well, investment information from the trust or custodial statement does not reconcile with the plan's records themselves. Well, we're going to have to do an investigation of that. The investment manager reports, if applicable, do not reconcile to the custodial reports. The investment transactions are not recorded or not recorded in a timely basis, right? One of the things you learn always in internal control is timely reconciliations of banks, transactions, reconciliation items, always timely done, is a huge positive for internal control. And if they're not being done timely or they're not being done at all, that is a significant weakness. Investment purchases and sales are not correctly authorized. Who's doing this and why are they doing it? Investment on financial statements do not exist or are not owned by the plan. And gains and losses are calculated incorrectly. You'll notice additionally, investments are not properly recorded at fair value or are incorrectly calculated. Investment details such as the type and description are incorrectly entered in the investment management system at the time of purchase. And then what are some of the procedures that we should consider? Obtain an analysis of the investment changes during the period, details about the name of the issuer, a description of the investment, the cost and fair value at the beginning and end of the period, cost of investments acquired, investment proceeds, and of course, investments sold. Obtain evidence of investment existence and ownership. Confirmations with third parties would be appropriate. Direct confirmation with that custodian, and maybe actually doing a physical count, inspecting them. If they're held in that facility, you could actually go and physically inspect them. You should have confirmations that there are no liens or encumbrances on them, where they didn't use the investment to borrow money to put it in cash to balance out a theft. Test investment transactions to ensure proper authorization, that all transactions were authorized by the trust documents or by the individual investees. Confirm the status of any securities that are in transit. Determine the accrued income, right? That's an analytical test. Test the fair values by comparing market quotations. Test the net change in fair value of the plan assets, and ask the administrator about compliance with plan investments, with investment policies, and then review subsequent transactions, right? Your subsequent review test is a very good one to see if something happened unusual, say in early January or February, that relates back to December, that suggests that maybe something wasn't recorded properly. Well, the fourth item here is going to be notes receivable from participants. You'll notice right here we have the relevant assertions are that all notes from participants are correctly recorded and exist, they're properly valued, and that they are initiated in compliance with the provisions of the plan. What are some of the risks that we could have here? Well, loans are not initiated in compliance. Loan details are not entered correctly. Loan payments are not properly calculated and withheld. Notice loan repayments are not recorded. So if somebody borrowed money and they owe it back, one, we want to make sure we show the right amount, we're properly accruing the interest, and that assuming that it's coming out of their future payroll, are we correctly calculating how much needs to come out each period? And loans in default are not properly recorded as deemed distributions. So what are some of the procedures you'd want to apply here? Well, examine the loan documents. Confirm loan balances, test for correct calculations, Ascertain loans are processed in compliance with the plan's policies, and review the financial statements. The fifth one is contributions, contribution receivables, and certain participant data. Notice contributions and certain participant data. Well, the variances will depend on the factors, like the type of participant data tested. Is it demographic data like birth date, marital status, dates of hire, dates of termination, payroll data, hours worked, earnings, contributions to the plan, and benefit data, benefit levels, benefit options that were selected, participant elections for salary deferrals, and investment elections, contributions and contributions receivable. Now notice relevant assertions. Amounts received have been properly determined, recorded, and disclosed. That's an assertion that contributions have been authorized and executed as required and as documented, that each participant has been properly included and recorded, and accurate participation data has been used. So what are some of the identified risks? Well, employees are not properly included or excluded. Are things being recorded in the proper period? Contributions are incorrect because of improper definition of compensation. Contributions are not calculated properly. Participant deferral rates are not entered properly. And failure of a compliance test result. So what are the audit procedures you'd want to have here? Well, you'd want to determine that the different classifications of contributions are calculated in conformity with the plan. Do a reconciliation. Does the plan meet the minimum funding standards? Determine if contributions are approved by the board for the employer contribution. Test that forfeitures have been properly applied based on the plan's policies. Review criteria for accruing contributions. Trace subsequent receipts. And ask management about timeliness of employee deferral deposits. Well, let's take a look at our sixth one, the rollover contributions. In this case, same assertions as for contributions, same recording and rollover contributions being authorized. That's your relevant assertions. Your identified risks would be the same as for contributions. The audit procedures: review the plan documents, reconcile the schedule of rollovers, test that participant investment elections have been observed, and review participant record-keeping accounts. The seventh is other receivables. You'll note here that relevant receivables, the amount reported in the financials, are for valid receivables, that they're correct and complete. Those are the assertions. What are some of the risks? Well, that interest and dividend receivables are improperly accrued. Income from securities lending is improperly accrued. Amounts due from brokers or securities sold are incorrect. And reimbursements are recorded incorrectly. So what are some of the audit procedures here? Test the accruals. Review supporting documentation. And review subsequent receipts to see if those amounts are actually collectible. The next one is forfeitures. This is where the employee received a matching employer contribution that had a vesting period, and we failed to meet the vesting period before we left the firm. So therefore, in this case, are the amounts properly recorded and exist? Forfeitures, are they properly presented and disclosed? And of course, amounts are used in compliance with whatever the plan documents are. Do they reduce plan expenses? Are they spread over the remaining vesting employees at that time? What's the plan document say? So the risks: forfeitures are incorrectly allocated. Unvested amounts are calculated incorrectly. Use of forfeitures does not comply with what the plan documents say, or the plan may have a partial termination. So what are the audit procedures? Well, review and determine how forfeitures are to be used. Then review the detail of forfeiture activity and review procedures for contributions and distributions related to testing those forfeitures. The next category is operating assets. The relevant assertions here are property and equipment are owned by the trust, and property and equipment are properly being depreciated. The risks: detailed property records are not reconciled. Like when you dispose of an asset, they don't ever reduce it. Actually, the one that I've seen there is they sold off assets that were used by the plan and they reported it as interest income and therefore still kept the assets on. So they debited cash and credited interest income as opposed to removing the asset, debiting cash and relieving the balance sheet of those assets. Be careful. Assets are improperly expensed rather than capitalized, and depreciation is not calculated properly. Audit considerations, test additions and deletions, and recalculate the depreciation, and evaluate the remaining useful life for reasonableness and determine if there's any impairments. The next category is accrued liabilities. The assertions here are that accounts payable are valid and amounts have been properly determined and recorded. There's no missing liabilities. The risks, amounts due to brokers are not properly recorded, so you're missing that liability. Unpaid administrative expenses are not properly recorded, so you're missing that liability. And investment management fees are not properly recorded, so you're not recording those. So here, test accruals, review supporting documents, and do a subsequent events test. Look at what was paid in January and February. And if at that time you're paying administrative fees, you're paying broker fees, you're paying all these items, look to see the invoices. Were they dated back to December and they just weren't recorded at that point in time? The next category is notes payable on an ESOP. You'll notice right here the relevant assertion or notes payable exist and are valid obligations of the plan. They are in accordance with the debt agreements and are properly classified and disclosed. That interest expense is recorded properly and unallocated shares are properly released to the participants. So what are some of the risks there? Debt is not paid in accordance with the agreement. Unallocated shares are not properly released when debt service is paid, and shares purchased by the plan may not be appropriately valued. So our audit procedures here summarize the note activity, determine that the terms of the loan are in agreement with the underlying documents, confirm balance payable from creditors, obtain a 5-year schedule of maturities so that you can always look back to do a roll forward there, and test that the release of shares as collateral is in accordance with the plan and documents. Our next category is participant benefit distributions and withdrawals. And once again, your relevant assertions are payments are in accordance with the plan provisions. Payments are made in person to the person entitled to them, and transactions are recorded in a proper account, in the proper amount, and in the proper period. Now, we'll identify the risks. Benefit payments are not properly authorized. They're not recorded properly. They don't agree with the record keeper. And benefit payments are not calculated properly. In other words, based on vesting. In addition, payments are not in accordance with participants' elections, and payments are made to a participant who is not eligible to receive benefits. Well, we have audit procedures to consider here. And in this case, we'd be looking at the following. Review plan documents. Determine that the distributions are authorized. Now, for death or disability benefits, examine the death certificate or whatever the appropriate medical documentation is if it's a disability, and reconcile the total benefits per the disbursements register with trustee reports. Investigate outstanding benefit checks, and if a third party is paying the benefits, obtain an understanding of the internal control procedures for that third party. You may have a SOC report right there, and review the plan documentation. The next one is plan expenses. The relevant assertions here are expenses are paid and expenses are presented and disclosed properly. What are the risks? Well, plan expenses don't represent allowable expenses. They are paid to fictitious vendors. They are not properly accrued. The expenses are not properly authorized, or expenses are not properly recorded by the custodian. So what are the procedures? Determine the expenses are properly authorized. So examine a cluster, especially those that are from the larger accounts recurring on a regular basis. Do analytical procedures and examine supporting invoices and documents and review service agreements. The next one is considerations for your ESOP. ESOP contributions and contributions receivable. Now, employer contributions as well as forfeitures are generally allocated by participants' eligible compensation relative to the total compensation. Dividends paid on allocated shares are based on the number of shares in each participant's account. And for a leveraged ESOP, there is a need for contributions to enable the plan to pay the debt service. Note, contribution receivables may be needed to provide sufficient cash to pay those distributions. Well, you have ESOP investments. Federal law requires that non-exchange traded employer securities have an independent appraisal value of those securities obtained annually. ESOP distributions. Distributions can be paid in cash or shares of the company or stock distributed, followed by a repurchase in an installment note. So what are the assertions here? Notes payable exist and are valid obligations. The notes payable agree with the debt agreement. Interest expense is recorded properly, and unallocated shares are properly released to eligible participants. What are the identified risks? Unallocated shares are not properly released when debt service is paid. Shares purchased by the plan may not be at proper values used to secure the debt, and debt is not paid in accordance with the agreement. So what are your audit procedures here? Analyze notes payable activity, confirm the balance is payable, and consider additional testing of dividend provisions, diversification provisions, and distributions. The next category is plan mergers and spinoffs. The relevant assertions are mergers and spinoffs are recorded according to the plan provisions and that they are properly presented and disclosed. What are the risks? Merger and spinoffs are not recorded in proper periods. Appropriate assets and liabilities are not properly transferred. The values transferred do not reconcile between the plans, and mergers and spinoffs are not fairly presented, nor are they disclosed appropriately. So your audit procedures here: review supporting documents, determine effective dates and terms, make sure everything was properly authorized, reconcile the net assets available for benefits, and compare a sample of participant accounts to make sure that before and after they reconcile correctly. Note, terminating plans. Note, you have relevant assertions that plan terminations are recorded in accordance with the plan, they are presented and disclosed properly, and participants are fully vested when the plan is terminated. Notice your examples of risks would be that it's not recorded in the proper period, it's not valued properly, and benefit payments are not paid only to persons entitled to them. So your audit procedures here: review supporting documents, determine that final benefit payments are in accordance with the plan provisions, determine that plan payments are made only to persons entitled to them, and determine that transactions are recorded at the proper amount and in the proper period. And then our final category, I told you there were 17 of them. Notice changes in your service providers. The relevant assertion is investment balances, payroll information, and participant data transferred between service providers are accurate, and amounts owed to or from the service provider are accurate. Now, identified risk examples: amounts transferred between the trustee and the custodians are not accurate or allocated properly. Participant data transferred was not accurate. Changes in the providers can cause delays in remitting salary deferrals. So what are our audit procedures? Test transaction processing, verify the total of participant accounts, and reconcile the assets for change in trustees or custodians. A lot of stuff right there. But just a couple of more items that we want to factor in right here. And one of them is limited scope audits under the Department of Labor. Now, the plan auditor does not need to examine and report on certain investment information prepared and certified by other institutions. In other words, if a third-party bank says, we're holding the following items for the trust, well, you're pretty sure that they had an audit, that they're giving you certification. So once again, this is going to literally reduce what you have to do. So you need to examine and report on certain information there. Also, insurance carriers that are regulated by the state or federal agency or similar investment institutions. Now, plan investments not held by a qualified institution are subject to the appropriate audit procedures. Now, reporting on supplemental schedules, a limited scope audit requires a disclaimer on the financials as a whole. The auditor also is precluded from issuing an opinion on the supplemental schedules. So the Department of Labor, what do they require? Well, they require the auditor to express an opinion on the form and content of the information included in the supplemental schedule, other than the information derived from the qualified institution, which we just mentioned. Now, the limited scope audit in a prior year, the administrator may elect not to limit the scope of the audit in the current year. Department of Labor regulations prescribe that an audit report includes a statement of net assets available for the benefit on a comparative basis. So there's your balance sheet. And a statement of changes in net assets available for benefits is required in the current year. So you've got both the balance sheet and what I'm calling the income statement. So a limited scope audit in the current year, the plan may exclude assets held by institutions that have certified the information in the current year, and the scope in the prior year may be unrestricted. Now, in a comparative statement, the auditor will report on the prior year statements of the plan. The auditor may refer to the date of the prior year's statements as well. Well, how about audit considerations of related party and party in interest transactions? You'll notice here an individual who has a relationship with a plan that prevents him or her from having certain types of transactions. So who are these people according to ERISA? Fiduciaries or employees of the plan, a person who provides services to the plan, an employer who employees are covered by the plan, a person who owns 50% or more of the employer, relatives of the person also mentioned up above. So service providers as parties in interest. That would be the independent auditor of the plan's financials, the third-party administrator of the plan asset custodians, plan trustees, and fund managers. So what are the prohibited transactions related to these parties? Well, generally prohibited under ERISA are selling, exchanging, or leasing a property, a loan, or other credit extension, furnishing of services, goods, or facilities, transfer of plan assets to parties of interest for benefits of parties in interest, and acquisition of employer securities or related parties that violates the 10% limit. So what are your audit considerations here? Well, you have procedures to assess the risk of material misstatement as a result of entities' failure to account for or disclose related party transactions. The auditor should ask management about who are related parties, identify them, the nature of the relationship, as well as whether the entity entered into any of these types of transactions. Notice the auditor inspection of related party transactions. Look at bank and legal confirmations, trustee confirmations, and read the minutes of meetings to verify them. Notice audit procedures, gain an understanding of the administrator's procedures and their controls, how the plan administrator authorizes these types of transactions, evaluate the controls in place, ask personnel for identity of related parties, review the work papers from prior years for the names of these related parties, and ask plan management if any prohibited transactions have been identified by past Department of Labor or IRS examinations, and ask about character of relationships between the plan and related parties or your parties in interest. You'll notice the records or documents that you may inspect, and there's a laundry list here: third-party confirmations, entity suppliers to regulatory authorities, statement of conflicts of interest, records of entities' investments in, notice contracts with key management, invoices and correspondence with plan advisors, significant plan contracts, and reports from internal auditors. Those are all fundamentals there. Well, that leads to our final category, which is going to be unique plan situations. Now, in this category right here, we're going to take a quick look at ESOPs, 403Bs, mergers and spinoffs, changes in service providers, and finally, we're going to take a look at SEC reporting requirements. So number one, employee stock ownership plans, the ESOPs. Now, in this case, an ESOP is a unique form of defined contribution plan. It has the ability to borrow money, and the ESOP invests in employer securities. Now, reasons for ESOPs, most commonly to transfer ownership of the employer company. I've got several small companies where the owner has relied on some really important people for a number of years and is basically to hold on to them and said, I will transfer ownership to you over a number of years. And they set up an ESOP plan to do that. What's a leveraged ESOP? It involves debt financing, often with a related party. Statutory exemptions from related party transactions exist in this category. Now, ESOPs borrow money to acquire shares of the employer. The contributions to the ESOP may be used to repay the debt. So the contributions typically from the employee go into the ESOP. The ESOP then pays off the debt that they incurred buying the shares of the company. As the debt is repaid, shares are released and allocated to the participating employees. Now, other forms of financing, the employer may make a loan to the ESOP. The ESOP may borrow funds from a bank. The ESOP may pay distributions to former participants through distribution of securities. Shares may be subsequently repurchased from those participants. Notice the plan usually obtains an annual appraisal of the company's securities. Leveraged ESOPs will have an obligation to the employer or a financial institution for the borrowed money that they took out so that they could buy the securities into the ESOP for the benefit of, say, those future owners, which are going to be usually the high-ranking, very valuable employees in a small privately held company. Participant allocations have unique attributes: eligibility, contribution allocations, allocation of income. Now, dealing with non-traded securities, they're valued by an independent appraisal. So when you have a privately held company, you're going to get an independent appraisal to come up with a valuation associated with it. ESOP statements, you disclose your assets, the basis used to allocate net asset valuations, and the segregation of ESOP shares held as collateral. Now, for your leveraged ESOP, it reflects the allocated and unallocated amount as separate columns, both in the balance sheet and in the income statement. Now, securities held by the plan, the lender has access to securities that represent collateral. And of course, you accrued employer contributions. Those are reflected once again in the balance sheet or the income statement. You also have accrued employer securities to fund distributions to terminated participants. That would be reflected in allocated columns, and it's not available for collateral. Well, another one is your 403B plans. These are known as tax-sheltered annuity plans, and it's a retirement plan. And as I mentioned earlier, my sister, who was a grammar school teacher for a particular city, she was part of this. So it's usually a not-for-profit. It's a hospital, a public school, like a grammar school, a high school, maybe even a college, right? Or it could be for even a private college. You'll notice employees here, it's very similar to the deferred provisions, but not identical to a 401k. You may also include an employer contribution, such as a matching. Auditors must understand the deferrals. Now, investments in a 403b, they can be in annuity contracts, custodial accounts, mutual funds, and changes in filing requirements. As of 2009, a 403b plan, they are subject to the same Form 5500 annual reporting plan as a 401k. You'll notice right here differences. First of all, the universal availability. 2, no trust requirement. Additional catch-up contributions for long service are allowed. The allowable contributions for terminated employees in years following the termination. No average deferral test. There's different distribution options, and no IRS determination letter is required for a 403B plan. Now, differences in disclosure. Descriptions of the plan, eligibility, funding, and tax status should reflect the requirements of the 403B plan documents. And then we have plan mergers and spin-offs. Plan mergers can occur as a result of company mergers and acquisitions. The effective date of the plan merger is often different than the date, and it's, by the way, it's typically before the transfer date of the related assets. A plan, you may actually have an acquisition occur, and let's just say they decide to do it as of the last day of the year or the first day of the next year. And yet the plan assets may be transferred, 30, 40 days later. You want to review the plan amendments and merger documents. You'll notice you record the net assets transferred on the statement of changes in net assets, the income statement, that you're removing them from this because they're going someplace else. Now, how about for a plan spinoff? If the plan sponsor sells or sets up a new corporation for division of employees, the accounts associated with those participants could be transferred to the new plan or an acquired plan. And remember, benefit obligations must be determined. Well, let's take a look at changes in your service provider. Changes in a service provider for a defined contribution plan are not unusual, right? You look for the best possible return you can get. You look for the one that will have the lowest management fees. And of course, all of the plan providers, they're going to bid and try to lowball and get the best opportunity they can, because they'd rather manage hundreds of millions of dollars and get a low percentage than not manage it at all. So therefore, you can have a change of record keeper, trustee, custodian, auditor. The Form 5500 disclosure requirements are, it requires disclosure of any change in your independent auditor. You have to have a requirement of Schedule C, as we noted earlier, and accountants and enrolled actuaries. You have to note them. And then finally, the last category is going to be the SEC reporting requirements. Now, in some circumstances, interests in plans are subject to the requirements of the Securities Act of 33, which means you have to register. Plans are subject to the requirements if they are both voluntary and contributory. Voluntary and contributory means the employees have the option to contribute their funds, knowing they may or will be used to acquire employer securities. Now, plans subject to the requirements require registration and annual filing of your Form 11K. Now, this requirement does not only apply to plans sponsored by employees with public traded securities, but 401Ks, plans with an investment option to purchase employee securities, that may trigger an SEC filing of the 11K. Some exemptions: defined contribution plans not involving the purchase of employer securities with employee contributions. And the audit requirements: plans required to file an 11K because you do have that option of purchasing employer securities must submit an audit to the SEC. And the SEC will not accept the limited scope audit that we talked about earlier when we were dealing with Chapter 5. Well, ladies and gentlemen, I'm looking at the clock and I see I've taken all the time that you've been so kind to share with us. We, again, had an ambitious schedule to cover all of this information. So the next couple of slides are the resources we use to build this material, and you can see there they are. But I want to thank you for joining us. So on behalf of Becker Professional Education and their CP program, my name's Tim Garrity. It's been a pleasure being your host, and I hope to see you again in other programs in the future. Until then, be well and be safe.